Let me start by introducing the team who has worked in this paper. There's three persons besides me from Finland, two from Aalto University, one from Hanken School of Economics, which is the Swedish Business School in Helsinki. Then obviously there's my favorite teammate Jill Collis there, who is so efficient and never lets me down. For example, she did send me this slide set yesterday evening to be presented here. So let's see how well I can read it out. The title of our paper is Does Capital Structure Drive Voluntary Audit in Micro Companies? So even though I try not to be too academic here, so I would like to say one thing, and so often in this kind of paper, so we either look at the determinants, the drivers that drive something, decision making in this case, for voluntary audit, or then we could examine the consequences. Here the focus clearly is in these drivers, so we try to understand a decision to have voluntary audits done. And the segment that we are examining is the same that we have been talking about during this morning, which are the micro companies. Now, how do we then examine those micro companies? Our main focus, main focus at least when we started the project, was to examine and understand from theory. We started and tried to understand why companies should do it, and we started from examining capital structure, how maybe banks or trade creditors would drive the decision, but we ended up then to go a little bit deeper into our analysis, and we complemented that by going into the motives of those owner-managers that do not have any external funding. I will come back to that. Now the context of the paper is the same again, which we have discussed a lot this morning, so I do not have to talk too much about it. So that's we are involved with the possibilities to maybe reduce the burden of small companies. Even though I honestly have to say that I do not neither understand how the burden goes down, so I very much echo the comments of Orlando earlier. So I do not quite understand all of what is happening in the year commission around the burden discussion. Now, if we compare Finland to when we talk about voluntary audit decision, so then we deal with the criteria, exemption criteria. Finland is a country where the exemption criteria is very low, extremely low. So those companies that are exempt from audit are basically, a lot of them, they are just one-man businesses, or maybe there's 2 employees, but that's pretty much it. Still, when we look at the statistics in a European level, those very companies are extremely important for the whole economy. So even though they are tiny, they are important. Now there might be a lot of differences between in institutional settings between countries. We heard already this morning we know that there's the continental type of countries. Then we can talk about tax alignment. It's stronger somewhere, less stronger in other countries. And in fact, when it comes then to the voluntary audit decision, from the prior literature, what has been done by Jill Collis, Robin Jarvis, and Len Skerrod, so we sort of did a test how much difference are there in the determinants in the voluntary audit decision. Based on this paper, we replicated that in Finland in order to understand, are they honestly so different? And there wasn't major differences at all. So in that sense, we already know that still the decision making might be quite similar within the SMEs. Now, what has not been done yet, no one really has touched the micro companies, which we do in this paper. So all these earlier papers, they deal with a little bit bigger, they deal with SMEs or even bigger companies than that. Now then, if we move towards or go into the theoretical framework, as this is, I say a couple of words about theory here. So we know that audit, what is initially the reason to have an audit in the first place, so it's well known that we mitigate information asymmetry between shareholder and then the manager. Now in this setting, within the micro companies, we rarely have that situation. There's the owner manager, manages the company, puts his or her money into the company. And what is quite particular then with these type of companies, so they have more limited access to funding, as by definition they do not get funding from public sources such as stock exchange, which makes them more dependent on debt and trade credit. What has been presented in earlier in prior papers is that in addition to that there is one element in those companies, and it's that it's very hard to, they are not transparent at all, so that might then still create a driver for auditing. Now we have three hypotheses in this paper. We start by so this that's the capital structure drive voluntary audit. We start the examination by looking at trade credit. We know something about trade credit before, but still there are quite specific elements to these micro companies, which I think becomes quite clear, for example, in the very recent report by Collis, Jarvis and Mike Page that they have been submitted to the ACCA. So there are these trust elements. There's sometimes these micro companies, they work on a relationship basis a lot, and it's possible that they don't even ask to see the financial statements that we learn from the reports, and even less so audit reports. So they are not necessarily so similar to SMEs. That's why we want to test it with the data, what's going on. Then bank finance is our next, what we examine. Now again, they might be a little bit different to other SMEs. These, as they are owner managers, they have a prior bank relationship. They are human beings that do not just appear from bushes or from nowhere. They have a prior relationship with bank, and that's why it's not necessarily as important that bank borrowing means as much there. Now then, our third hypothesis relates to the relation between bank funding and trade credit. Which one plays a bigger role? This is not clear either. It's not obvious which should be the case for micro companies. We know, on the other hand, that in banks, there they have this special trained staff, their personnel who do financial decisions for their job. They are very good in that. Then on the other hand, we know that trade credit relationship for micro companies, there are a lot of possibilities for trade creditors that banks do not have. They can, for example, they know what's going on with the company. They are in close contact all the time, and they also can stop the deliveries if they do not receive their money, which puts them in a different position than banks. That's the third thing that we examine. So how do we approach then our tests? So we've collected from 3 consecutive years pretty much the whole population of micro companies in Finland. We do this in Finland not only because I and most of the team live there, but we have a particularly rich setting there because all companies, all limited liability companies, file their reports in public register, and there's a very contrasting situation to what I heard from Mike this morning about the abbreviated accounts. That possibility to some extent exists in Finland, but it's extremely rarely used. That's the very small minority that uses the option. So we have almost all of these, all of the companies in our sample. And then we do interviews. The variables that we use here, the important thing here is that, as I said earlier, we look at the drivers. We try to explain the decision of voluntary audit. And we do that with variables related to capital structure, by adding also control variables for those effects that are known already in the literature. So we take that into consideration. Now, then when we look at what's going on, so first this one slide where you can see years are here down on the horizontal axis, and then this is the use of voluntary audit in vertical axis. So one interesting thing is that as we started from the year when it first became possible to not have financial statements audited, we can see quite clearly that in countries where there is a tradition that something has been always done in a certain way, there is a clear hesitance to be the first user of the option. So what we can see here that from year to another, the further we go from when it became active, possible in Finland, so the use with different kind of capital structures monotonically decrease across the years. Another very important, interesting to us finding was here that when we compare, here's the green line here is the debt, use of debt in the companies of our sample. So in fact, when we compare that to any other, and when we compare it to the use of equity, there aren't huge differences. Also those companies that do not have any external funding, they still for some reason want to have a voluntary audit. Now the statistical tests of ours, they show that yes, also in micro companies, debt and trade credit, they are drivers of voluntary audit decision. There's a positive correlation, yes, that explains. What we also do find is that there's a difference between those two explanations. Debt is a stronger driver than trade credit. That's what we find. Now, as we had 3 different years, we saw that there's a monotonic decline in the use. So obviously we wanted to also examine it on annual basis, because we didn't know if we get the same results. And there again, there was quite very interesting finding, which I think can be generalized to other changes of law and regulation. So the further we go from when the standard became effective, the better the theoretical models explain behavior. So in the first year, in the second one as well, we find noise. There are many companies, they really don't know what to do, and that's why our results are not so strong in the early years. When we go a little bit further, they become much stronger, which we can see from the explanatory power here. Now, as there were so many companies where we didn't find any reason for their behavior, for their voluntary audit decision, we decided that let's not stop here. We started to do interviews. We went to those companies that didn't, in our sample, seem to have any reason to audit. And that gave us a very rich and nice list of different kind of explanations why they do it. Here's just 2 examples. One was that they said, this makes, at least to me, a lot of sense, the same explanation as there's many other, in many other business situations. I don't want to do something that isn't my core. If something isn't my core business, let's outsource it, let's give it away. And that's what we heard in the interviews. They said that we don't know, I don't know, I know my business, I give all the finances to someone else who knows it better. It makes a lot of sense. Then another thing which was somewhat hilarious to realize during the course of the interviews were when many of our interviews, they mentioned the tax authority. They said that they are more positive towards us when we have our financial statements audited. And for example, there was one who said that we asked whether the voluntary audit has some kind of an impact towards the treatment of the tax declaration by tax authorities. They said, definitely, we have had at least 10 years without any queries from tax authorities, and it's of significant importance. What we did next, we went to tax authority and asked, is this true? And then they said to us, we know, we have heard that some people believe that that is the case, but that's not the case at all. We treat them completely in the same way as if there wasn't any audit. However, if there's not a clean report, then there's a big problem. Then we react, otherwise not. Which seems to create a disincentive rather to voluntary audit than anything else. Now to summarize what we did find when we examined the motivations for voluntary audit within micro companies. So we got empirical research evidence supporting to that capital structure plays a role. We also did see that it plays a bigger role if there's a bank debt in question compared to trade credit, but trade credit also plays a role. We also found that there's a large number of other reasons for voluntary audit. And that's why the point that we raise at the end of our paper is that any regulatory bodies, when they consider the alternative of auditing, so they should be aware that there's a lot of idiosyncrasy there. There are very much firm-specific reasons and also general reasons other than capital structure.